Welcome to the Talking Advisory and Client Solutions podcast. My name is Leah Crowley, and in this series we're taking a look at a range of topics that you might know a little bit about but want to get a better understanding of. We will discuss a range of topics like buying and selling a business, valuations, due diligence, debt advisory, sustainability, financial transformation, and a whole lot more. In this episode, we're going to have a chat about buying distressed businesses. Should you? Should you not? Should you run away? Or should you walk towards? We've got Todd Gamble again here, a partner in advisory at HLB Mann, Judd. How are you again?
Great to be here. Thanks for having us.
This is an interesting topic we'll be talking about today because I think if you speak to someone just on the street and you say, do you want to buy a business that's not doing too well? Most people go, no, why would I do that? But there are reasons, right?
Yeah, there's a lot of reasons why you can get good value from buying a distressed business. It's just about how you approach it and understanding what the issues are.
When we're talking about distressed business, what kind of business are we actually talking about?
You can talk about a distressed business which is informal, administration, receivership, liquidation, or you could have a business which is potentially going that way, which is running out of money or under pressure to pay debts that it can't satisfy, or has other issues like a founder has died, the owner has died, there's been a change in the industry. All of those sort of things can make something distressed. Obviously, at the moment, we have supply chain issues, which means that some businesses are distressed, and also things like employee shortages.
So usually when a business is or somebody is looking to buy a business or acquire a business, they've been looking. But with a distressed business, is it sometimes the owner that is looking to sell?
Yeah, we often see in this scenario with a distressed business where, particularly with the age of a lot of family business owners now who are in their late 50s and 60s, and they have relationships with competitors who they somewhat trust or at least acknowledge are possible acquirers, and they approach them and say, I'm not going very well. I don't think that this should continue. Would you like to buy me? Here's what I think in terms of sale. Are you interested?
Yeah.
Sometimes those terms are realistic. Sometimes they're less realistic and they just try and offload the problem.
Yeah, right. It's like a panic sell.
Yeah. Pulling the parachute, let me out.
I don't want to be here anymore. Don't make me stay. Yeah, okay.
But the moral of the story is they're trying to protect their employees and their business underneath all of that. And they maybe can't see the way out.
But can see that someone else with fresh eyes, a different perspective.
Or more money.
Or more money, yeah, that's true, would be able to fix it all and really make it flourish. Yeah. So why would anyone want to buy a business that have these issues? And, okay, I do have all of this money to buy it, but why would I spend my money on it?
A lot of these distressed businesses have 3 or 4 key problems. It might be they don't have enough sales, so they're not making money because of that. They might have a structure which is too expensive, so they've got too many employees or too many of the wrong employees. And those things can be fixed. You just need to structure a transaction or the business going forward properly. So it's about trying to actually fix the business and acquire the bits that make sense. So as we talked about with Nick, is here a share sale's probably less likely because you're probably looking to cherry pick the bits of the business that you want rather than taking the whole thing.
So this is the kind of business where people do cherry pick. So you potentially may even have 1 or 2 different people buying parts of.
Yeah, and sometimes you can also just divest of certain aspects of it. You can take one leg off and leave the body, and that can make more sense. Particularly at the moment, these transactions can occur where people are looking for more market share in certain areas or expanding into areas where they don't necessarily have the skills, but they can manage it. And the other reason why these type of transactions works is because you can take out a lot of management costs. If you have an existing business which you've got strong management, but they're underutilized because they don't have a larger volume or a larger business to be able to run, those guys can be activated and you don't need to bring those management costs over. So effectively, you're creating a larger business that your current management can run without and maximising your actual return out of the investment going forward.
Yeah, okay. So suddenly someone has got a whole new lease of work life where they suddenly have all of this all these new responsibilities that they can really cherish and nurture and try and create some amazing new business that flourishes.
Apply their regime, which has been successful, to a poorer performing business. So you can go from a management team that's running a $20 million business can probably run a $30 million business relatively easily.
Yeah.
And you can buy that overnight at a relatively reasonable price if you're buying in a distressed scenario.
I mean, it must just also make everyone feel great when suddenly like, hey, we're turning it around. This is so cool.
And some of the people who do that because they feel that responsibility.
Yeah, okay.
And because they understand the industry they're in, they can see that, yes, it might not be making money now, but if I buy this business and add it into mine, it will give me the opportunity to expand when the market transitions in the near future.
And I guess when you were talking about competitors, that's probably the kind of scenario that they're after. You know, we were both doing the same thing. You were doing something slightly a little bit differently though, but maybe I can incorporate that into my business.
Or I was undercutting you to win the work.
Yeah.
Which meant that both of us suffered.
Yeah.
If we worked together, i.e. as the same business, all of a sudden we can say, well, this is the pricing, and the business starts to make more sense.
Yeah, of course. That's cool. So if you're interested in a distressed business, what's the first step? How do you go about it?
If there's a public process,
yep,
you register interest in that and try and get access to the information. I would also suggest that you talk to your advisors. If you have an accountant, talk to your accountant about how you do it, and talk to your lawyer around how you would structure it and try and minimise that risk. You also need to think about funding to make sure you've got enough cash to be able to do it. And then probably on top of that, look to get an expert to assist with the structuring, because in these type of scenarios, you need somebody who's familiar with the process so that if it's an insolvency practitioner on the other side, they can see that you understand and it will help you manage the process, because sometimes in these processes that you might have 3 weeks to do DD.
Really?
And get no warranties or no undertaking, but you'll have full exposure to all the information.
Okay.
So there can be an investment up front to do that, rather than throwing that investment against the wall by not getting the right advisors. Get the right advisors in to see and do an initial analysis and say, this is where we're at. And if you can't meet the timelines, talk to whoever's the selling party and see whether that will work for them. If it doesn't work for them, well, then you need to just say, well, it's too hard.
Yeah, right. In a distressed business sale, how common is it for the previous owner to stay on as an employee for a certain amount of time? Is that something that doesn't happen?
It depends on the business.
Yeah.
If you look at something like Virgin, Bain came in and ripped all of the management out eventually. But in something smaller where there is a lot of personal relationships, particularly in family businesses, there will be a transition period where they might maintain those relationships to convert them over so the incoming management can then have or own those relationships going forward. There's also an aspect there where you're treading around not creating a competitor again, because some people will sell and then maybe go around and do that.
Oh, sneaky.
It's been done before.
Yeah, okay.
So there's a balance between all of those aspects and trying to get the business and the value that you are acquiring. So making sure you're doing that. If you look at an accounting business, for example, you need the partners because the partners have the relationships with the clients.
Yep.
If the partners want to retire or something like that, you need to work through a transition with them and the clients. And that's a lot of that's about respect and management and communication to make sure that they feel comfortable.
Yeah, with clients as well. I mean, that's your bread and butter, so you don't want to.
Clients and customers make the business. Without that, so the major things at the moment, employees, because without the employees you can't deliver.
Yep.
Without the customers and clients, you don't have a business.
Yeah.
The other thing that's obviously difficult at the moment is supply. If you were previously getting items coming from the Ukraine or Russia, you don't have supply now, so you're looking at alternative supply.
Yeah.
And even things like steel, there's steel in construction in Australia, which was previously coming from the Ukraine. It stopped. So the construction industries have to go and find new supply.
Yeah, just pick steel up anywhere, whatever.
Well, our Chinese friends make a lot of it as well, but we don't necessarily.
There's a lot involved here. Like, this is not a thing that's just, hey, I know you, you know me, let's do this. There's so many different aspects.
And if you look at the employee issues, some of the things we talked about with Nick is that's an overlay here. And generally when you're in distress, there is more employee issues as well because it's a more stressful environment. People are concerned around their entitlements and their employment.
Yep.
Stress leave is not something uncommon in these sort of scenarios. And sometimes there is also employee issues around varying things from not performing to fraud and working your way through that. So that can be some of the risk factors that you've got to confront.
And the employees that are there and they're very stressed out, they don't know whether they're going to have a job tomorrow or whatnot, do they see a potential buyer as a threat or do they see it as a good thing?
Depending on who it is, and in some industries there's 3 or 4 options. Yeah. And depending on the communication that's going on through the process, if it's management is still in place and it's just a distressed sale without a formal appointment, there can be varying levels of disclosure. The rumour mill, from experience when going in as a formal practitioner, the rumour mill is frantic. People tend to actually spend more time worrying about the rumours than actually doing their jobs at different stages. Yeah.
Their brains just won't let them focus on the work. It's too overwhelming.
It can be really, really impactful on the operational side of having this distress situation hanging over the top. So when you can actually give clarity and when we're on the formal side, we try and give clarity as much as we can. So
you can give the employees clarity?
You can. And look, once if you're acting on a buy side and you're looking at it, once you've got into preferred status or you're the only buyer, everything's down to that. Yep. You can start talking to them and give them 2 things. One, I think your vision of what you think the business is going to look like. Yep. And then the reality of what you're going to do with the employees at this stage. Mm-hmm. Because people want the truth. Yeah. And if you give them the truth that, look, we're going to review each of you. If you're a good performer or we think you work in the business going forward, we will keep you. We'll do everything we can. That will give people confidence, and you also give them a timeline which says, we're going to make a decision in the next 2 weeks. We'll talk to each of you. We've got to do interviews. We've got to do all of this stuff. Yep, yep. People start to get more comfortable around the process. They're still uncomfortable, but they're comfortable that things are moving forward. Well, there's no great unknown anymore. It's the known factor. And if you're the buyer, you're tying up the key employees is the first thing. Yeah. Because without the key employees, the thing can unravel very quickly and your value unravels. Yeah. Well, they're experts in their particular fields, or at least they should be. So they know more about that bit than we do. Yeah. Yeah. And look, it's usually relatively straightforward to work out who they are. Yeah, okay. And is that your job? Like who's doing that? Well, if I'm acting on buy side, we're looking through and going, first of all, thinking about structure to minimise risk, and then going through the DD process. Yep. So they're all of those things are aligned. Once you come up with a structure that sort of works and a value that you think your client works, and you work through with the client, say, okay, this is the sort of area where we think you have to pay. This is the structure and these are the reasons why. Here's the key issues you need to work through. Here's your key contracts. Here's your employee DD that you need to do. at the moment we'd recommend doing a wage review, underpayment and whatever else as part of that, and then looking at, okay, if it's in a competitive process, where do we think the market will be and why? And then trying to understand for the vendor side, what would be attractive for them. Speed is often more attractive in some of these scenarios than a larger number paid in the future, because if the business is continuing, it's bleeding money.
Yeah.
So if you can do it faster, you can fix things faster and you're not incurring more losses.
Yeah, right.
So it's about trying to open up that communication with those parties. And if you've got issues with a certain problem or a certain aspect of the business, either just put it to one side and leave that bit and not acquire it, or be honest and say, this is a problem, this is the pricing issue, how do we fix it as part of a structure, or how can you help us do it? And getting the vendor to involved in that conversation.
So there could be an opportunity to acquire growth. Like we've talked about, the fact that you might see it, you might have the funds to get through all of this and really see something amazing come out of it with skilled people from a distressed sale. But what about the old debt from a distressed sale? Do you just go, I don't want that?
Yeah, depending on how you structure it. Like if you are recapitalising an entity via a deed of company arrangement or something similar, or you're doing a business and asset sale and moving everything into a new entity, you can leave the debt behind or you can compromise it. So
what do you mean when you say compromise it?
So if you effectively acquire the entity via a deed of company arrangement, so you replace the existing structure existing owners. So you can do that. You can buy that in a sale. So you can do a deed of company arrangement which leads to a sale or is a sale of the assets or the shares, and you can propose to the creditors a compromise. Whether that compromise be a payment, which means they get a certain percentage of their old debt, and that is full and final settlement, or they get a success fee coming forward if the business is successful and there's contributions that come through, or they have to transfer something. There can be all sorts of assets contributed back in, and that is what it is.
Yeah.
So we'll take this bit. All of those assets can be realised. So the right boot continues and keeps walking. The left boot gets sold.
Yeah.
And whatever the proceeds go, pay the old employees or the old entitlements or the old unsecured creditors.
Yeah, right.
So they can be left behind and sectioned off. And generally, though, if you've got a business going forward and you've bought it, you want those suppliers to be supportive. So part of the due diligence process is to agree ongoing supply to make sure that you don't effectively create a problem by compromising their debt and them getting disappointed. Pissed off would be the normal word, but disappointed.
Yep.
And they say, well, I'm not going to supply you, or they change your pricing on you to recover their debt.
Yeah, right. Which, that sounds totally fair. They want their money, I guess.
It's a little bit of the law of the jungle.
Yeah, sounds like it. So you kind of mentioned this a little earlier on, making sure that you have the funds to buy a distressed business, but how easy is it to get finance for this kind of?
It's getting more difficult than what it was 12 months ago when there was a lot more money around in this sort of area and it was cheaper. But there are structures and people who are willing to and understand distress, who are willing to provide funding to assist you. Generally, those parties look at an asset base and price on the asset base or structure on the asset base. So one of the things I recommend for my clients is if they want to buy something but the distress is concerning and it's not clear whether it will recover, it's more of a let's do it, let's see if we can make it work. If we can't make it work, we don't want it to sort of damage our main business.
Yeah.
So in that scenario, I'd often suggest getting more debt to buy the business and putting less money in out of the successful business, and then if it doesn't work, releasing the assets for the debt to be repaid.
Yeah, okay.
And moving on. The fail fast scenario still is a very effective way to look at it. And if you're going to make the investment, there's also some security structures I'd be putting in place to make sure that you protect yourself, and it's part of the risk mitigation that we would assist with.
Yeah, okay. What types of risk mitigation can occur when you buy these businesses, like without warranties and that kind of thing?
That's where your due diligence becomes pretty critical, and also getting access to all the books and records. So generally, if it's a formal process, if you get all the way through the process, you'll have access to everything.
Yep. Because
there is no warranties, they don't withhold anything. So subject to you being able to assess it and do your due diligence properly, you can mitigate your risk through that. And also things like that structuring I just talked about, leaving it in a special purpose vehicle and not contaminating potentially your successful business with this riskier aspect. And obviously there's a number of legal issues you need to go through that. And similarly with the employee issues that we talked about with Nick earlier, you don't know what you're necessarily buying yourself into. So isolate it to a certain extent so you can manage it in there and keep your risk away.
Yeah, there's so much you have to think about, but I guess that's the importance of processes like due diligence, so that you're really just checking everything, making sure that you know what you're going into and how to get out of it.
And the difference in distress is that to a certain extent you can price in the due diligence risks, and you're able to buy at a lower level, or you're able to buy a business that you would not be able to buy or set up cost. So one of the comparisons we try and do is to say, if you were to set up this business or build this business, how much would it cost? And it might be, say the number's 10, and you can buy this. Yes, it might have some hairs on it, but it's 4. So then the costs of actually doing it can be factored into it, and you look at it and you go, well, if I can turn it around and turn it into a business of 10 by spending 4 and 1, 5, I've created value for myself that's greater than the sum of the parts.
Yeah.
And that's the way a lot of our clients look at it when they really understand what they're doing.
You kind of got to know, or at least enough. You know, obviously you need experts like you guys to come in and really go through it, but you kind of need to feel confident in yourself.
Yeah, and the entrepreneurial sort of style of business owners, they like risk because risk means opportunity and return. It's just about managing it. And I've seen a number of people buy things from us or be involved in the process and just going, I can't see how this is going to work. But by hook or by crook or by luck, whatever else, things do turn around and value is created.
Opportunities.
Well, and that's it. If you've got dry powder as well, you've got cash. What are you going to do with it? Can you create, even if it's not a core business, but is it something that you can build and then sell off?
So overall, distress appears to be like a wonderful opportunity if you understand the business and potentially what went wrong. So, you know, even some costs in exploring a potential acquisition. Like, what kind of value is there?
I mean, I think Bain is probably having a trouble with Virgin at the moment because it's taken longer to get things back up.
Yeah.
But there's probably a boom in travel coming.
Yep.
So that value will start to deliver for them. There's also a number of smaller businesses and a lot of other businesses around construction at the moment which are really struggling with some contracts that have broken them. But it doesn't mean the underlying business isn't good and the people being able to deliver isn't good. It's just that there's a pricing model problem. So if you can work through, and if you look at the ProBuild example where the acquirer of those entities has expanded into Victoria by doing that and expanded into other projects, that's a great opportunity for them to expand and get a workforce that they were looking for that they couldn't have done. They couldn't have actually done it themselves. They couldn't have built it themselves because it wasn't physically possible.
Yeah, right.
So if you look at things like that and you see opportunities, and even for things like intellectual property, where some businesses might have absolutely collapsed and failed, but the intellectual property might be valuable for somebody to be able to park and garage on the basis that it might be the next thing. One of the most competitive processes I've ever been involved in was as the administrator selling A vitamins business, and we had people rocking up with bank checks to our office after we'd already agreed to sell to somebody else. And that created a real problem for us, because once we signed a deal, we're done.
Yeah.
But then the secured creditors started changing their position and whatever. So it created a chaotic scenario that we had to work through relatively quickly. But the reason was because the opportunity with that business was to expand into China, and that industry provides a multiple return that drives great value very quickly. Similar to like IT and tech businesses, if they land certain contracts or can expand their market share, because the cost base, the incremental cost base is minimal. Some people can go, I can turn that into this if they have the foresight and the ability, which is beyond me, to go, that makes sense. I can do that, and I can make 100 times.
Foresight and ability, you need both of them, don't you, really, for this kind of thing? It's phenomenal. It's so exciting.
And you make your own luck.
Yeah.
If you take the punt, sometimes you can get there, but if you know what you are doing and you can see the vision, and then obviously a lot of people can sell the vision, but whether they can deliver is... And it's pragmatic. If you can, again, going back to, if you can buy something which would have cost you 5 to build and you can buy it for 2, and you can strip out some costs and it starts covering its costs so it's not distressed anymore, you've got another little add-on to your business. It makes a lot of sense.
Yeah, it makes a lot of sense. So distressed businesses are not scary, you know, as long as everything is looked over with a fine-tooth comb, you're on the path to success.
Or you structure it and you just de-risk the entire thing, and you say, I'll buy the business and these assets and that's it. And that way you just leave all of the issues behind, even if there is some hairier problems, and you know what you're getting.
Yeah, yeah. And any last words, any last thoughts before we wrap up?
I think there's a number of layers to these sort of transactions, and there's some legal aspects and some accounting aspects, and then there's some commercial aspects. And I think we can talk about those separately. But the biggest thing to understand with all of this is that there's about understanding who the people are in the process. Who is the person who is the vendor, whether it be a formal insolvency practitioner or whether it be a director, and their advisors, and what they want, where they're trying to get to. And then the people in between, who are the major parties in it, which would be your key contractors, your landlords, your employees, your key customers, and going, okay, that I will understand, and where value stacks up for you. Because if you do that analysis at the start and you know where you are, you can have a very quick conversation and avoid having to wade through the DD if it's not going to work. So people understand value and work it out before you go and jump into the deep end.
Amazing. This has been really, really informative, Todd. I thank you very much. We'll have to have you on again soon, talking maybe a little more in depth with some of these different aspects. I think that would be really interesting.
Unfortunately, I'm always happy to talk about risk and insolvency.
Amazing. Todd, thank you.
Thank you.
Todd Gammel's expertise and knowledge is part of HLB Mann Judd's Advisory and Client Solutions Services. For more information, please visit our website, hlb.com.au.